All right. Good afternoon, ladies and gentlemen. So we're going to give it a few minutes, just before we kick off, just to allow people troop in and allow people just settle in. So in the meantime, for everyone here, welcome. I'll just like for us to just in the chat box there, if this is your first time joining, please let us know. If you're a repeat attendee on this event, please just let us know. So basically just, and also let us know where you are joining in from. So if it's your first time and you're joining in from Lagos, first Lagos. If you're a repeat attendee and you're joining in from Lagos, repeat Lagos. Great. Um, so please let's do that while we allow people joining. All right, great. So Michael, first timer from Lagos. Glad to have you here. Um, yeah, Philip has been on these meetings before. Joining in from Edo State. Um, Toyosi repeats Lagos. Love it. So if we can be quick with that, so we can just get a feel of um who we have in the room. Oh, Michael. Oh my God. Hey kid, you want to like yeah, best. All right. So yeah, let's have them going on. In 3 minutes time, we'll kick this conversation off. Thank you so much, Michael. Let's get some more comments, please. We want to know if this is your first time. We want to know if you've, joined these meetings before and where you're joining in from. So you can just send it up in the chat box while we get ready to kick off.
Should be Chinevu is in the audience.
Yes, I saw Chinevu's name. That's interesting. First time from Abuja. Oh, nice. Nice. Love it. Chinedu, glad to have you here. To be said now, I'll place my hair. It might not work out for you to be. Nevu, glad to have you here with us, man. Rotimi, first time based in Lagos. Glad to have you here with us, Nevu. I mean, Rotimi. Ooh, new member from Chicago. Love it. Really love it. All right, one more minute. First time from Canada, Antonia. Love it. Glad to have you here with us. Um, First time from Atlanta. Yeah, Chicago is up early. Canada as well. Yeah, glad to have it. So, um, it's a diverse audience. Love it. Okay, so yes, we're 5 minutes. First time from Yaba, Fee. Glad to have you here with us, Fee. Um, Yaba is Lagos. um, yeah, so welcome, ladies and gentlemen, to the Rise Investment Club meeting. These are meetings that we have on the last Saturdays of every month. And the point of this meeting, the goal for us in this meeting is to share insights, actionable insights with a community of investors, a community of people who care about finance and doing better about their personal finance. The point is that you join these meetings and you get something that you can use to better your finance. Um, so for this particular meeting, the topic today is how Rise is investing for you during this downturn. So usually for some of these meetings, for a lot of these meetings, we usually have guests, but this time we decided to keep it in-house, and there's a reason for that. So just a bit of context, over the past 2 years, majority of the financial markets have been doing, fine, after the pandemic hit. So when the pandemic hit, obviously that brought some shock waves. But the US stock markets, for instance, did pretty much well that year and the year after. So what happened was that because of the nature of the lockdowns, there was a new influx of participants in financial markets. So, a new demographic of people started investing. You can recall the kind of action or the kind of traffic that a company like Robinhood had during that period. Um, so because markets were booming at that point, it almost felt like it was going to be like this forever, and you know almost everything was doing well. Even Bitcoin hit peak prices that we hadn't seen before, so everything was just looking all rosy. But that's not facts, right? That's not reality. Markets do not go up forever. um and now at the start of this year, it's been a different story. And those demographic, that group of people that came into the markets are starting to feel a whole lot different. For a lot of them, it's the first time that they've really participated in this type of market, so there's a lot of panic and whatnot. That's the reason why we decided to um you know pick this topic for this month, so that you as a user of Rise get a little bit of insights to how Rise is managing your money. And if you're just on the fence, you heard about the brand, you heard about Rise Vest, and you're not just sure, particularly because it's a rocky market right now. This this call or this webinar would also do you some good, right? So the format of this discussion, really, we're going to speak about the three asset classes on RiseVest. So if you've not used the product before, I want you to know that there are three asset classes on RiseVest: stocks, fixed income, and real estate. So we're going to speak around these asset classes. And joined with me here today is CEO himself of Rise, AK. AK, hi. Do you want to just say hi to the room before we kick off this discussion?
Sure. So I have been in and out for a lot of our last few meetings. One, because just sheer amount of work that we've been doing in-house. Secondly, because Chibi was doing such a great job, kind of managing the meetings along with our guests. So I'm here today. Glad to be back. Glad to be actually speaking to all of you. It's been a while. And then also to share with you all about the specific actions that that Rise is taking to continue to invest your capital over this whole period, and to also talk about any opportunities, of which there are many, that can still be found in a market such as this one. So yeah, that's I'm looking forward to the whole chat.
Thank you so much, AK. So let's jump right into it. AK, the first question I want to ask you, as as an investor myself, I read the news, I jump on Twitter, and I hear that, oh, markets are red right now. Um, and I would also hear people who are good about finance, people who know about investing, and they'll be like, oh, you need to buy the dip. Oh, this is actually a good time to be in the market. I personally understand that. But for people who don't, explain the rationale of why does it even make sense to even invest during a downturn? Why should I even be bringing my money into the markets when I'm hearing that, everything is red? Can you explain that rationale to like the average man?
Yeah, sure, absolutely. So I know that especially when I first started investing, it seemed very counterintuitive to me, talking about going into the market at the time when everywhere is down. But when you've lived through situations like this enough times, you actually realize that, yeah, there is, not to be academic about it, there is actual logic towards buying at this time. So the simple way is when you consider the underlying assets that are available on the market, any kind of asset you can think of, real estate, stocks, fixed income, any investment that you can consider, at these times when everywhere is kind of like bloody and the whole market is in a panic and everyone is trying to sell, those are the times when those investments will be bought at a very affordable price, right? So that's like the simple logic. This is the time so when everyone says, "Oh, buy low and then sell high," um, these times like this. Those are the only times that you're going to buy low, right? So because why else would anybody sell a profitable or a promising asset to you at a low price? Is because everyone is panicking. Everyone thinks, oh, our money is going to go away. Everyone thinks, you know what, we're losing so much money, we need to get out of the markets. If you can have the discipline to override that emotional response and take that longer term view of, well, these assets might be down a lot today, but they are going to bounce back eventually. The mood or the market sentiment will not always be negative. And if I have the ability to put in money now, I'm going to go ahead and get a much better return once the market sentiment comes back to normal. So that's generally the way, the reason that it makes sense to purchase now. I can talk about the expected returns aspects of it, but that would be me going academic. However, it's not something that is very easy to do, right? So it's not something that comes too naturally. When everybody's panicking and selling, you also want to panic and go to fly to safety. But if you live through the pandemic period, it went down and then it came back up and people profited. If you go back to 2008, it's the same thing. Everywhere was bloody, but people who stayed in bounced back up and they made money, and so on and so forth. So it happens long and long and long. And after a while, you realize that, oh, that's just how the market behaves. And I'm going to wait for times like this. And when everybody is trying to get out, that's when I want to get in.
Great, thank you for that. That makes a lot of sense. So that gives context to, when people tell you that, oh, you need to do the opposite of what everyone is doing. So when everyone is selling, maybe that's the time you should be finding some buying opportunities. So that makes a lot of sense. Now let's talk a little bit about our fixed income product, our fixed income plan, or on the RISE product. So inflation has been going crazy, not just in the US, not just in Nigeria. It's almost like a global issue. And we hear that, so because fixed income, exactly like the name says, it means I'm earning a specific return, so if inflation keeps rising, it makes fixed income a sort of less attractive asset class to invest in. But the rise plan delivers 10% per annum guaranteed, on that particular plan, which is still above, the current US inflation rate, which is also very high. Now, my question on behalf of the audience is, what changes are we making? What changes is Rise making to ensure that the returns that we get from that fixed income plan is still stable and still beating returns? I mean, inflation.
Yeah, that's a great question. So I think in any market environment, especially in this kind of market environment, the first priority is to understand the level of risk we're exposed to, right? So across our portfolio, we have, that's same for what the providers of our fixed income hold in their portfolio. We kind of have a general understanding. There are some that are doing consumer credit, some are doing mortgage-backed credits, some that are doing, sovereign bonds. Majority of it actually is sovereign bonds, high quality corporate bonds. And so we're asking ourselves, what risk are we exposed to? What exactly is this asset class going to do around this time? So on the sovereign bond side, there's not a lot of issues there, so most sovereign issuers are able to ride out situations like this. They might have some constraints here and there, but they're generally fine. There are some assets that might be a little bit, there's an elevated risk because there's less liquidity, there might be defaults and things like that you kind of keep an eye on. But generally, we're not too worried about where the portfolio is at the moment, especially because fixed income by nature is designed to as for capital protection. So the returns don't have to be crazy and the duration isn't very long term. So in our case, it's about 12 months for most of the fixed assets that we invest in have about 12 months duration. Now, what that means is that as cost of capital, because of inflation, banks are raising rates, central bank is increasing rates. So by the time we go back and try to roll over some of these assets, some of them will have higher yields, which also means that we are going to get paid a little bit more for holding them, which gives us more inflation protection. And in the other cases, because again, it's a 12-month period, we know that as long as we're staying above inflation and as long as we're achieving that capital protection without taking undue risk, the portfolio will be okay. So that's how that we've not made too many changes, but we have our eye on the risk. We have our eye on the portfolio. We're looking at the cost of capital situation and the rate situation, and we're expecting possibly by next year, all things being equal, we might actually do slightly above 10 if there's enough demand or there's enough yield increases that our general portfolio is going to earn more than what it is now. But even if it stays at the same, even if it stays at 10%, as long as the risk is not dramatically higher, we should be good. We should keep our hands, keep the portfolio as is. And that should also be good enough for the people who have currently invested in that portfolio because they're achieving their capital protection. They're still beating inflation. They're not taking any undue risk. So we should be good. Also, on the first point that you were making about why it makes sense to invest during times like this, especially, so I'm using equities now as a good reference point. I highlighted like 3 examples that I was going to use as an illustration of the point of investing during this time. So one of them is Amazon. So there was a point when the tech bubble burst in 2001, and Amazon went down by 90%. So it went from like 400 and something to like high tens or mid tens. And even the CEO of Amazon at the time, he was looking at their business and he's like, our business is growing, our revenue is increasing, our stores are opening and people are still using our services. And by all metrics from the business, things were going better. But from the stock market panic, the price had gone down by 90%. And I'm sure a lot of people who had held on Amazon at the time, a lot of people sold, right? But he, knowing the business numbers, he actually was buying more. And a lot of people who were looking at the business numbers were able to tell that, yes, the stock markets might have dipped to a point where again 90% of the value. So if you had put 10,000 at the time, you have $1,000 left in your portfolio, and some people panicked and sold. But when you look at the underlying business and you see that the underlying business is doing okay, then you know that your money is always going to bounce back. So from that point, they have grown like more than almost 100-fold in terms of, so if that 1,000 would definitely be closer to 100,000 today if you had just held on. Another example I used, I actually tweeted about, was Snapchat. And this one I know from experience. I didn't really want to invest in Snapchat. And we discussed it a few times, didn't really move forward with it when it was at $14 during the pandemic, because we're like, yes, their numbers are growing, a lot of things are happening on the tech side, but it was still such a risky play. So we missed out on that one. And we've kept our eye on the business since then, and the business has improved and things have grown. At some point, it went from $14 to like $50, $60. And people were like, oh, we wish we bought it then. Today, the business has not dramatically changed. Yes, the current expectations are a lot lower because people are not spending as much digitally, as much time online, people are not doing the same kind of spending. But the business the stock just fell down to $15. But if you keep your eye on the underlying business, you realize that this business is selling at a massive discount. So what I want to add to the first point that we made is, once you stop looking at the stock price is an opinion, right? People think the business is worth A today. Tomorrow, they think it's worth 10 times that. Next tomorrow, they think it's worth half of that. But if you can ignore that opinion and keep your eye on the business fundamentals and try to understand which business is doing well, you are much more likely to keep your eye on the ball and not panic when others are panicking. So just that was kind of like an addition to my first statement.
Thank you so much for that. I'm glad that you also shared the example of Snapchat, because we talked about that a bit on our Telegram channel, where Snapchat's stock price just dropped because it came out and said, "Oh, hey investors, we might not make as much money as we said we are going to make before, just because, like you said, people are just spending less digital." Spending less dollars on ads, and then it just dropped. But at the end of the day, is it a stable business? Is it a great business? So that's a great point that you make. Also very happy to hear that, like, our fixed income plan still remains like a great place for protecting your capital. So thank you for that. Let's speak about real estate then. So we've heard that the US real estate markets might have peaked and then it's cooling down at the moment. What is Rise doing to make sure that it's still, because for me personally speaking, the real estate plan on Rise is a great source of income. Every month there's returns that comes in, so that's how I treat it. I treat it as a great source of income, right? What is Rise doing to make sure that this plan or this portfolio still keeps on bringing as much income as we expect? I mean, we Rise put out a message one time saying that it added Airbnb rentals to the portfolio. So this might be part of the larger strategies. Just speak a little bit to us about maybe the market overview, and as well what Rise is doing as far as real estate goes.
Awesome, sure. Thank you. Real estate is one of my favorite asset classes on Rise. And we have it on our portfolio. We have it as part of our assets because going back to really the very beginning, we studied several asset classes and how they behave during recessions, right? And we found out that rental real estate is one of the most resilient asset classes that are out there. And the reason being that the demand profile is so strong, even when there's a lot of decline in the market, even when people are economically challenged, a lot of people would always at least want to make sure that they pay for a place to stay, right? And so it's one of those very resilient asset classes. Now, what has happened in the real estate market in the US over the last few years is the prices have been going up pretty steadily for a long time. And it's driven by, there's a low supply of housing, new housing in the US. There's growing demand from millennials that are starting to purchase houses more and more. Renting a property has become more popular and more convenient than owning in a lot of times. So what has happened is the demand side has grown, but the supply side has not. And so we've written that, again, going back to a few years ago when we started, and we were asking over the next 10 years, what asset class is likely to do the best. And real estate had the best expected return profile. Now, today, the prices have gone up so much that people are starting to ask if it still makes sense to buy houses around this time. And from our perspective, it still does. And the reason it still does is we're not playing the game of let's try and so either flip properties or take advantage of rising prices. The game we're playing is let's purchase houses that would generate consistent returns from rent every month. So in some ways, like this current month, May, has been the first time in a long time where a property we're trying to buy, we actually saw the listing price drop. So they lowered the listing price because people were not buying it enough at that initial high price, which has not happened, at least for that I can tell you, in the last year, almost 2 years. I've never gotten into a property where before you know it, the prices are going up, but now it's starting to drop. And for us, it's a good thing because the return that we make on the property is basically how much can we collect in rent divided by, after expenses, divided by the purchase price of the property. So if we're making 15% and then the prices drop, the rent has not dropped as much as the prices. So we're actually seeing the possibility that our returns from real estate might improve. Secondly, we are going after new markets. So there are markets that have not run up as high as the more popular markets over the last couple of years. And so we're looking at markets like Indiana, Memphis, Tennessee, Columbus, Ohio. We're looking at, there's a few other places around the Midwest. So we've moved from Southeast and that East Coast corridor to like moving more inland, and you're seeing like double-digit rental returns very easily. And then the third thing was adding the Airbnb property. So we realized that Airbnbs have a higher average return if you find them in a great location. And so we're looking at, so our strategy is how do we find the high traffic locations? And so when we bought this property, we looked at the location with, so they say real estate, a lot of it comes down to location, right? And so not to give away some of the strategies that we use, but we've tried to understand where does traffic flow? And then we buy Airbnb properties in those areas. So that property that we listed, we put on the market in April, ending of April, and it was booked till June, a week after we launched it. We're just getting the report now. It's been booked till September. And again, the average return on that property is in the 20s, which is a bit higher than our traditional portfolio. So we're still looking for more deals like that to expand into, so that even though the US market is cooling, we are still going to be able to deliver returns to our investors.
Thank you so much for that. That was an expansive response. So we're pulling up to the half-hour mark, ladies and gentlemen. So I can already see from the chat box here that someone is already asking a question. So we are free to ask questions, please. And of course, we even encourage that. I'm going to ask AK one more question, and then we're going to move to questions from the audience. So please use the Q&A section at the bottom of your screen just to ask your questions. I can still see from the chat here that we have, I think, a good number of first timers actually. So Busola is a first timer from Surulere, Lagos. Kike Lomo is joining from Germany for the first time. I love it when I see people outside Nigeria join. Bolande, first time. Michael says, fact, the real estate asset is amazing on Rise. Yes, it's one of my favorite plans actually. I usually don't, I'm usually excited to see those returns hit during the first week of every month. Tosin is also joining from Italy. So ladies and gentlemen, you can please post your questions in the Q&A section, and AK, I have one last question for you, and then we take questions from the audience, right? So now let's talk about the big boy. Let's talk about stocks. Right. So the last time I know we put out some words saying, just talking about some changes that we are making just to um, hedge the I guess downturn that was in the rise stock portfolio. And we talked about adding a commodity ETF. Um, I I understand it, and I read the thesis, and it made sense. But the question I do want to ask you is, of course, you said when you're talking about real estate, you said you weren't going to give out secrets, and I don't expect you to. So, just from the scope of what you can talk about, what can you tell us about how Rise is positioning itself or positioning this stock portfolio so that when the market bounces back, I, as an investor in that stock portfolio, I'm set up to benefit from that.
Sure. So we have the approach that we've taken is, first of all, there are some positions that we know we do not want to sell out of, even if so. Towards the ending of last year, our portfolio was outperforming S&P 500 up until the last quarter, when growth stocks as a whole took a hammering. And it's not like they were completely unpredicted. However, we know that some of those companies have really strong solutions, really strong markets that they're growing into, and we don't want to exit them because of these temporary dips in their value. So what we've done is, the first is we increased our market hedges. So generally across the Rise portfolio, we have a market hedge position. And what a market hedge position is, because we have a lot of long, I'm trying to not get technical. So we have a lot of investments that are betting on their continued growth over time. And we also have exposure to the broad market index, so that means is we have a basket of exposure to most stocks on the general stock market. It's just saying, okay, we're in the stock market, and as long as the entire market is growing up, there's some exposure to that. We also now have specific positions that we think is going to deliver better returns than the overall market. Then we have a position, so what the hedge is a position that shorts the market, so that when the market is going really well, that position might suffer, might do badly, because that position is like a bet that the market will decline, right? So we have a small amount of money in a position that bets on the market going down, and it kind of protects the portfolio from a lot of shocks when it goes up and down. Now, when the market is now on a decline, as it is right now, that position will profit, it will gain. And so when we increase our holding of that hedge position, so it's things like PSQ for hedging on growth stocks. There's SDS that hedges against the S&P 500 as a whole. There's a bunch of other market hedges that we use, and we increase one or the other based on where we think the market decline is pushing from. But the overall goal that has achieved is that our portfolio will not go down as much as the overall market, because as the market is going down, in some cases, we are gaining from those hedge positions. So it's a bit like a portfolio protection. Now, the second thing we've done is, given, again, understanding that a lot of this recession is driven by high inflation, challenges in the supply chain globally, and a lot of energy demand that has been caused by reduced investments in fossil fuels, right? So we realize that energy is going to be in demand, and a lot of agricultural and mineral commodities are going to be in strong demand. And so we basically increased our holdings of an index that bets on oil, on metals, on agro-commodities, and that position specifically is actually up by 17%. So again, it gives us additional market protection. The third thing we've done is that we've increased our holdings of some of the stocks that we believe strongly in, some of the stocks that we know they're going to do well. Once all of this bounces back, they're going to be really good. So we've increased our holding of Apple. We've increased our holding of Berkshire Hathaway, because Berkshire Hathaway has exposure to the US markets, which is incredibly strong despite these shocks. We've increased our holdings of companies like Bill.com that streamline and make small businesses a lot more efficient, because everyone is going to go, especially SMEs or small businesses across the US and across the world, they are going to focus more on being more efficient with their spend, making sure that they are not wasting a lot of their resources and streamlining their processes. So we know that those guys are going to still do well. So we've increased our holdings of those kinds of positions. The last thing we're doing right now is what I call, we're basically hunting for companies that have now fallen and their price is so low that they are now a very attractive investment to make. And so we start gradually deploying into some of those positions. One of them is a company called SPGI, so S&P Global Incorporated. So what they do is they provide ratings. They're a competitor with Moody's as well. So they provide credit ratings, they provide market intelligence. Some of those things that are always going to be in demand, we've added some of those to the portfolio. In fact, the updates for that is going to go out sometime, I believe, on Monday. And lastly, we've not quite deployed a lot into this direction, but given the state of the world right now, we're looking seriously at some defense and healthcare companies that have, again, increased demand around this time. So, but the summary of all of these moves is that, one, if you keep your eye on the long view, you know that eventually the market is going to turn around. And some of those deals that people are running away from today, for instance, Facebook, people have acting as if Facebook is not going to make advertising dollars anymore. And meanwhile, we're looking at the size of the platform, we're looking at everything that they're doing, and we know that they're going to be incredibly valuable. So we know that the market will bounce back. We just have to give it time. We know that energy and inflation and all the rest of them and even if they are transitory, they are going to control the markets for a while. And so we're increasing our positions on those investments that profit from that kind of market environment. And lastly, we're taking some increase in our defensive positions. And some of our stocks that we know, maybe they are growth stocks, but we don't have as high conviction in their ability to do well, we've also sold out. So those moves are currently always happening, and we're currently always keeping an eye on what the market is doing, because our job collectively, our job at a high level is to make sure that we're applying our expertise towards helping you all grow and protect your capital, no matter what the market delivers. And then looking for, even as all of this thing is going on, let's say, what if the market stays like this for the next 3 years? How do we profit from that? How do we make sure that we are actually making money or delivering value in markets like this? So some of it might be recommending increasing real estate exposure or increasing fixed income, but some of it might also be just buying extremely valuable companies at a massive discount based on what the market is giving today, and then wait for it to pay off when the market bounces back.
Thank you so much for that, AK. So let's move on to questions from the audience. First question here, Tosin is asking if you can explain how the Build Wealth plan works on the platform.
Sure. So Build Wealth is essentially a long range plan that is designed for how you're going to go from wherever you are to achieving a level of financial freedom and how long it'll take you to do that. So it's essentially the way it works in practice is, if you say this is the number you want to achieve, this is like where you believe you need to get to, and you say this is how much you're willing to invest every month, or this is how much you're required to invest every month to hit that number. And then based on the timeline, we then spread your assets across the 3 asset classes on Rise in a way that is designed to achieve that your goal. So if you have a long range goal and you need higher returns over a longer period, then we're going to weight you more towards stocks while providing you a percentage of real estate and fixed income to provide that diversification and stability. And so those asset mix, and then the amounts that you need to invest every month in order to then hit that your big number at, say, in a year, 2 years, 5 years, 10 years, 20 years, however long your number is. However, you can actually withdraw from that plan at any time. However, it's a good way to have, like you have, it's like a GPS. You know that you're driving towards somewhere. And for most people, if you're thinking about retirement, you're thinking about long, I want to have, if I have like $500,000 that is just yielding returns for me, build wealth is probably going to be like a good plan for you to set that as your goal and then break it down into monthly amounts that you need to consistently invest in order to hit that goal. So that's how the build wealth plan works.
Great, love it. So build wealth is a long-term plan. Tosin here again is asking, if I hold mixed assets as a retirement plan, I hope it's safe on the Rise platform.
Yes, absolutely. So the assets that we select would take a lot of time and thoughts and process to make sure that we're holding assets that we know are going to stick around for a long time. And then even our operations, the way we're structured, the way we're regulated on both sides of the ocean, we've answered a lot of this and shared a lot of information on this, and we constantly do. Because even currently, right now, we're transitioning as the business grows. We'll make changes to the structure so that we are always maintaining the capacity to serve for a really, really long time. So some of these things, because of the sake of our time, I won't go into all of them in detail. But what I can tell you is that Rise operates from the standpoint of how can we ensure that this business is here serving our customers for decades into the future. And then we do everything with that in the back of our mind. So yeah, please reach out to us, hello@risevest.com, so that we can more specifically answer your question in detail.
Yes, definitely. Definitely. Ugochukwu is asking who and what determines stock price? Like what you said about Amazon doing well, but their stock wasn't doing well at some point. Could it be that it's been manipulated or what?
So especially in the US market, the ability to manipulate stock price. So it's essentially demand and supply, to be honest. And so if you have a really thin market and you have a lot of capital, you can move prices around. But for the most part, it's really hard to do. It's just during times like this, when everyone is trying to sell, or everyone is panicking, the demand for those stocks are going to drop, which means their prices are going to come down because not as many people are trying to buy stocks. That's why their stocks drop. But if you are someone that can actually stick around and hold on to those stocks, eventually when the business continues to do well and continues to report good performance, then the demand for those stocks are going to come back, and more people will now want to buy, and so their prices will increase. So most of the time, it's basically a demand supply conversation.
Thank you. Yes, Ugochukwu, it's pretty much demand and supply. It's pretty much market sentiment. Stuff comes out in the news, something happens, and then it makes everybody feel like, oh, Amazon is going to crash, and then people start selling. So yeah, it's just market sentiment. An anonymous attendee is asking, does the Russia and Ukraine war affect US economy and stock markets, and should we be wary?
It does. It actually does. Several companies are exposed to either the Russian markets or are impacted by the war itself. And to be honest, there's not a lot that can be done. So in answering the part about should we be wary, there's not a lot that can be done really on that part of things. You just have to take this as a case-by-case basis and then ask yourself, for instance, ExxonMobil lost a huge, almost 3 billion in their Russia business. But at the same time, oil prices have soared and their existing holdings have continued to deliver a lot of value. And so regardless of what the market conditions are, a smart investor will be able to understand what is the next best move in order to make sure that we're in a position to profit from it. And so that is what Rise then does on your behalf.
Thank you so much. Chinkata Okpara is asking two questions actually. One, how are the capital gains on real estate calculated and reflected? Given real estate is not
Mhm.
liquid, if you experience a large outflow from the real estate assets, say because of a fall in price, what plan or approaches do you have in place to deal with such a scenario? So that's two different questions.
Yes. Chinkata, this is a very brilliant question. I appreciate it. So in the first case, when we have capital gains are usually when there's an outflow from the portfolio, when there's a sale on the real estate portfolio. And long-term rise investors will know that there are periods when you see higher than average returns on your real estate. Typically, those are because there's been an exit or there's a disposal on the portfolio. And so the capital gains is also spread to investors. You usually have to stick around a lot to experience that because we generally try not to sell. So we just focus on the existing cash flow. But yeah, whenever there is an exit or whenever there is a sale, the investors on the portfolio also get extra distributions from those. The second question, which is that given real estate is not liquid, if we experience a large outflow from that asset, how do we deal with that? This is one of the reasons why real estate is not as open-ended as stocks, for instance, where on the stocks plan, you can exit and you can invest and withdraw pretty much at will because we can easily liquidate your position and send out that cash, or in some cases, we'll send it out to you, and then when we liquidate, we balance out. However, for real estate, we always have to have a duration for your real estate plan so that we can have more predictability around the outflows. And based on the outflows, we know that, for instance, in the US market, which has the advantage of being an incredibly liquid real estate market, at least as far as liquid markets, as far as real estate can be made liquid. If we put if we put a property on the market within 30 to 45 days, the process has closed and the money is in the bank. So if there's a lot of redemptions, it'll just be that we're going to sell a lot of the properties, but we have more than 30 something properties, and everybody that is in the real estate portfolio, their money is invested in a specific property. So it might take us a while to sell, but we will be able to liquidate everybody if it ever came to that. The last thing is that purchase we purchase our properties typically with a discount on their market value because of the way we source those deals. So let's say on average, let's say a $200,000 property, we're buying it on average for 150, 160,000. What that means is that if we need to hit the market today and we realize, okay, everybody's selling at 220 because they want to like take 200 after all the expenses, we can sell at like 180 because we're already sitting on some comfortable margin of safety, which makes it easier for us to liquidate fast and able to settle anybody who wants to withdraw. So that's scenarios that we also like evaluate all the time. And I'm glad you asked that question because it gives us an opportunity to share that with you all.
All right. Thank you. So an anonymous attendee is asking, how is Rise different or better than other similar platforms? What makes Rise unique?
Yeah. So so how is Rise better than investing in some of that platform? So a lot of these platforms, you're trading by yourself, and research, and I'm sure some of you guys' portfolio returns would show that when you're trading by yourself, you might make money on one or two positions, but your long-term returns are not going to be so great because it's not your full-time thing. You're not dedicated to everything that you need to do on a daily basis in order to make sure that you're on top of, and not physically on top of every news, but you know what's going on in your portfolio every moment, and you know the right moves to make. You don't do that all the time. And so you're going to have long-term returns that are basically not great. That's the first thing. So Rise, we knew from day one that If we left it just like that, people have things to do, people have other interests. They're not going to sit around and do this every day. So by doing it from here, by doing it on their behalf, we're much better able to both distance ourselves emotionally and also do a lot of research so that we're actually buying positions, not just based on what is popular or trending, but based on things that are valuable. And so our returns in the long term are much more likely to be better than your returns doing it for yourself. That's the first difference. The second difference is that Rise, by having multiple assets, allows you to invest in different things depending on what the market is doing. So if the market is up, you can shift from real estate to stocks. If the market is down, you can invest more in real estate and fixed income. And so you have the ability to really build a portfolio that can do well in different market conditions. Lastly, you are paying a lot less in fees. So in some of these platforms, you pay a 1% or 1.5% when you buy, you pay a 1.5% when you sell. Whether you make money or you lose money, you're still making those payments. And it costs you a whole lot more. By the time you calculate all your trading fees, you have paid a whole lot more without necessarily saying that you've gotten a whole lot more value. Meanwhile, on Rise, you pay a single AUM fee of 0.5% if you're above $1,000 or 1% if you're below $1,000. And that's the only fee you're going to pay to us, other than the card processing fees that our vendors, our suppliers or the vendors charge. But generally, you have much better returns on Rise, much better choice of assets. You have someone else doing all the work for you. And at the same time, you are paying very little in fees. So it's a much better deal overall. And we've always wanted to be that way because our goal is to win when you win and not to just win at your expense. So I don't know if I answered that particular person's question, but I believe that if you go back and check the platform you're using and run the numbers versus what we're doing on Rise, I'm sure you'll agree with what I just said. I want to answer the question about why Rise is not accepting crypto deposits from Nigerians in Nigeria. Yes, SEC has already released a guideline for the cryptocurrency market, but the bank regulator, the Apex bank regulator, which is CBN, is not allowing crypto transactions to flow through our banking system. And so for Rise, because we are regulated and therefore we always have to work through the traditional finance or banking systems, we are not going to enable crypto transactions for users in Nigeria. It's not that even though SEC has all these regulations in place, we still have to rely on the banks. And so we have to kind of stay away from that for users in Nigeria. So hopefully that changes at some point, or hopefully we get different guidelines. But for now, users in Nigeria can't use the crypto deposit feature. But if you are outside of Nigeria, then you should be able to make use of it.
I agree. We're almost at the hour mark, but we'll try to answer some of these questions as quick as possible. There are some product questions that I've already answered in the chat. So someone is asking, are we looking to buy stocks from outside the US?
Yes, we are. So already we purchase across US, European stocks. So some of the APIs we use to trade stocks allow us to do US and Europe primarily. I've explored India because there's a lot of growth happening in India right now. The challenge is that the Indian stock markets or their regulations in general make it very difficult for foreign players to invest in their market, right? So there is some friction there. We're thinking about and looking for ways to bypass or be able to invest, even though those restrictions are there. China used to be one of the places I'm looking at, but they have several risks that are not just market risk, but political risk, capital controls risk, and so on and so forth. And the goal of investing is to make sure that you are able to return or deliver long-term returns without taking on undue risk. And so it's not always just the investment risk itself, it's also all the other things on the side. So if other markets open up or become interesting enough, I've not taken a close look at Latin America because mainly for infrastructure reasons. But the short answer to that question is yes. Our goal is to find returns that we can deliver for our users anywhere those returns are being made anywhere in the world. So for instance, it might be easier actually on the real estate side to find opportunities to invest in markets that are not in the US. That is a lot easier. Europe, some places in Africa. And also there's a new, both asset class and also a new product that is on the works. Someone asked about investing in businesses or startups and all of that. And again, that's something that we're working on. When it's finalized, we should be able to do beyond Nigeria, beyond the US, and into like other markets in other places. Michael, I don't know. I can neither confirm or deny. I just,
Mike. Okay, so we're going to take one more question from the audience. Just pick one question that is not a product question that they could just get response by sending an email to. So yeah, you just pick one and then we'll call it
yeah.
a day.
So payday, okay, that's a product question. Let me see which ones are here. Okay, so the question about if Build Wealth Plan is designed for the long term but permits unlimited withdrawals, how does compounding work on the plan, especially that is a composite of all asset classes? The compounding works because usually if it's multi-year, then after every year, whatever returns you generate is kind of like reinvested across all your asset classes. But some of it is also just you making that commitment to stick with the long-term goal that you set. We have this thing, we had this conversation on our product roadmap where we have an option where you have a locked track and the open track. The open track you can withdraw whenever, and obviously you have to be disciplined enough. And then on the locked track, if you think you cannot stick to it unless we lock it, then we'll have to lock it. But we didn't default to that because when you're giving people a long range plan, imagine that you're doing like 5 years plan, and then we tell you we're going to lock it for the whole 5 years, or maybe you only withdraw 1 or 2 times in the whole 5 years. So you might not like that as a user. So we had to defer to a better user experience in the short term, but we might add a locked plan so for the Build Wealth or for those long range plans, so that those who want to commit for that long term and they are willing to lock it down would have that as an option. Speaking of decades into the future, what is the succession plan like for RiseVest? And getting the general tone of the conversation. Yes, there is a lot. First of all, as the business scales, my day-to-day involvement is not actually as how do I put it? So my job changes as the business grows. So we're doing strategic conversations, but the investment research sits mostly with other people in the team now. Deployment sits with the different people in the team. Even day-to-day operations, my co-founder, Tony Odiba, is sitting on day-to-day operations. And they are different as to our US operations. For instance, I'm currently in Nigeria. We've been buying houses for the last several months. In April, I was not, I was pretty much out the entire month of April. And that didn't really stop the business from running because we've kind of understood the systems and the processes that allow us to do what we do. And those things don't just sit with me in particular. Obviously, as a startup, early it's early in our day or in our growth. And so, yes, I have a lot of responsibility, but it's not just me. So if for any reason I dropped off the face of the earth today, Rise will still deliver great returns, still find and curate great assets, and still continue to release great products long into the future. So I don't think you should worry too much, Uchenna.
Thank you so much, AK.
Um,
So we're
yep,
yeah,
time.
yeah, this is 3 p.m. This is 3 p.m. So we have to call it a wrap. So I'd like to say thank you to everyone who joined this meeting. Um, Great questions. I think it was a great conversation. You can still keep on talking to us. So I posted a link there to our Telegram community. You can join that community. We're always trying to learn together. We're always trying to have great conversations together. Join there. The link is on there. Um, I also, so I'm also going to post our email address. So just in case you have questions, you have further questions, you have questions on here that we're able to answer here, speak to Rise. The email address is hello@risevest.com. We'll be glad to hear from you. And yes, thank you guys. Somebody asked the names of both of us. So my name is Chubi. This is AK. I'm going to post the Telegram link one more time because somebody just asked for that. Um, Copy, paste. So there you go. There you have it, ladies and gentlemen. At the end of this call, and we have come to the end of this call. At the end of this call, once I end this, you're going to get a feedback form that's going to pop up on your screens at the end of this. It's just 3 questions. We want to know how much you enjoyed this. We want to know what you want to hear about going forward. We want to know if you'll be able to like recommend this to your friends and colleagues. So please just take 1 minute and answer that for us. So again, thank you everyone. Thank you, AK, for joining us. Yeah, cheers, guys. Enjoy the rest of your day.
Thank you guys. Have a wonderful one. Bye.